Hey Money Guy family, it's your host Brian Preston, back with another episode of Ask the Money Guy.
That's right, you guys have financial questions, we've got your financial answers. Go out to your favorite social, use the hashtag AskTheMoneyGuy, or you can go to our website, moneyguy.com, and ask a question right there.
It's Brian Preston, the Money Guy.
So Brian, today's question comes from Trin, and she put this on the Money Guy website. She said, can you explain the differences between the custodial savings account for minors and why you would choose one over another? In other words, what's the best way to save money for my kids?
Saving for the old kiddos. First, I gotta give you the Money Guy disclaimer. Remember, it's no different than when you're flying on that airplane and they say, put that oxygen mask over your face before you take care of the kids.
Right.
You know, it's the same way with your saving for the future. Make sure that you have taken care of your basics for financial independence before we start worrying about junior and all the family members and making sure the kiddos are taken care of. So let's get into these 4 different options. That's
Perfect.
what I plan on covering today. The first option, and this is really going to be for option 1 and 2, is custodial accounts. When I'm talking about custodial accounts, I'm talking about your UTMAs, I'm talking about your UGMAs. If you want to know the difference between these two, the UTMAs can hold real estate and other assets, whereas UGMAs are kind of limited to your traditional, cash, stocks, bonds, and mutual funds.
But essentially what they are is they're a custodial account where the child is the beneficiary of the account, but you as the parent or grandparent serve as the custodian or the signer on the account. Is basically what they are.
And these are very easy to access. That's why people like them, is because there's no income limits, there's no withdrawal penalties, there's no earned income limits. We'll talk about that with another option. So they are very easy to set up. The problem with these things is that they if you start earning too much money, they're subject to what's called kiddie taxes. And believe me, guys, once you have income over $2,200 in these custodial accounts, it gets ugly because they get taxed like trust and estates, which you don't have to make much money at all. Usually a little over $9,000 a year before you're paying like 35, and then it quickly jumps into 37% taxes. So that's a problem. Now, when you're thinking about custodial accounts, the easiest, and I think this is a tradition left over from a bygone era, is people go to the easy low-lying fruit of just going to their local bank and opening up a custodial account. It's a savings account.
For a savings account to just drop in $20 a month or something like that.
The problem with that setup is your local brick and mortar bank account is going to pay you probably less than 0.25%. And you could even look at some of the online accounts. I know Discover Bank offers custodial. I know Ally does. But they're even only going to pay you a little over 2%. So that leaves, if you know this is going to be money, I will tell you, I have a custodial account for my daughters for weddings. And that's something I know that I'll need that money at some point. So I have set up custodial accounts for them, but I've done it at a custodian like a Charles Schwab or a Fidelity Investment, something that you can actually hold investments in, because I think that gives you a few more opportunities than you could do if you were just doing the bank opportunity.
And the way it essentially works, is while you are the custodian on the account and your child is a minor, you're the one who kind of controls the purse strings. But something does change when the child reaches the age of majority, right?
Yep, they usually, depending upon the state, 18 to 21, they are going to gain access to those assets, so you need to be very careful of that. I'm trying to think if there's anything else that I always tell people to be careful with custodial accounts, but I think that covers the basics of it.
I think that's it. Let's talk about number 2.
Number 2 is, and this is the one that gets me excited, it still has the word custodial in it, but now it's Roth, which we know, just if you know anything about the Money Guy Show, we love Roth assets because that means they have access to tax-free growth. And when we talk about tax-free growth, think about a 14-year-old that saves any type of thing for the future. $1 has the potential, depending upon if you're talking about making 9% a year, it could potentially be 100 times over. So that $1 could turn into easily to $100. If you're talking about somebody, if you did like the S&P 500 where it could grow at 10% a year, that money easily could be worth over $150 by the time they reach 65 at retirement. That's an incredible opportunity to have that money grow tax-free. So, but there's a catch. There's got to be a catch with a Roth, and there is. Here's the problem with saving in custodial Roth accounts. You first have to have earned income.
That's right.
So if you don't have any type of wages, if you're not filing a tax return, these things probably are not eligible for, you're not going to have access to them.
And it's important when we say earned income, that's income that you are actually reporting. It doesn't just mean that you're paying your kid to do some chores around the house and you flip them a $20 bill. They can't then go contribute that. You actually have to report to the government that your child has income to be Roth eligible.
So definitely, custodial Roth accounts open up a lot of opportunities. So the who, when, and where, and why you would use a type of account, when you go back and look at traditional custodial accounts, that's money that you want to have access to. I told you I want to use that for like weddings. For a Roth, a custodial Roth account, the use for these is going to be money that these kids are going to need and go ahead and be able to be realistic and responsible, set aside for future retirement. That's what I would want to use that for. And then that leads us to our last stop on this. The option 4 is 529 accounts. These are accounts that you're going to set aside for education savings. We like these because if you use them for education, they grow completely tax-free.
Right.
So you get that same benefit as a Roth IRA, but they have to be used for education purposes. And as we know with the new tax reform, it's actually K through 12 education for private schools, as well as for your college savings or going to beauty school, trade school. It's not just your traditional 4-year schools that these things can be used for.
So with a custodial Roth IRA, like you said, one of the things you have to do is you have to go find a custodian that will actually house that. One thing that's unique about 529 plans is that they're actually offered by the state in which you live. So one of the things you'll want to do is you'll want to go review the state where you live and see maybe if there's an incentive from a tax perspective for you to open up a 529 with that state. If you don't have a state tax incentive, you can actually open up a 529 with any state to go choose the very best low-cost provider out there.
With any minor's account, you've got to be thinking about, what does this have an impact on financial aid? A lot of people are nervous about that. You should know custodial accounts directly going to be counted as assets that will be used in that calculation on financial aid. 529's a little grayer because if they're in the child's name, the parents are tied to it, it's probably going to be counted. Grandparents, probably not counted.
Sure.
And then here's the cool thing about the custodial Roth IRAs. Because that money is counted for long-term use for retirement, it's not even on the application. So that's another benefit to those custodial Roth accounts, is it's not going to hurt you in those financial aid calculations. I do want to close out with one word of caution. You heard us mention all these custodial accounts, when you reach the age of majority or maturity, depending upon how these things are structured, that's 18 to 21, the kids will gain access to these funds. So you need to go ahead and start the planning early so that they have a healthy, responsible relationship with money, so that by the time they get to that 18 to 21, it's not one of those uncomfortable things where they go and they buy the Corvette or they buy some squandered choice there, instead of making that money work for them and having a huge head start on becoming financially independent, and let that army of dollar bills get to work for them.
That's great. If you have a financial question you'd like for us to answer right here in the Tesla, go out to your favorite social, use the hashtag AskTheMoneyGuy, or you can go to our website, moneyguy.com, and ask a question right there.
Guys, thanks for the questions. Keep them coming. We'll be back shortly.